we have a housing shortage. I'm going to get to that in a minute, but in addition to increasing the amortization on high ratio mortgages on new homes for first-time buyers, they're also extending the RSP withdrawal limit for a new home to $60,000, just recently announced. And you know, people always ask me, should I withdraw money from my RSP to buy a home? Well, guess what? If it's going to take you 30 years to pay for it and you lose that compounding impact to your savings, I don't know if it's a win-win, okay? And now with a $60,000 withdrawal and you have to pay it off in 15 years, you now have to contribute $4,000 a year back to your RSP in order to avoid the taxation on that money. And that is about $333 a month, which provides even more burden to a home buyer in addition to the increased costs of a home, interest rates, and whatnot. One thing I will say, they've limited this 30-year amortization on high ratio mortgages to 30 years. They've limited to just new homes, okay? And you know, as Ron Butler and myself have pointed out on many occasions, and a lot of people, not just us two, but everybody, the amount of development charges, taxes, surcharges, and fees, HST, on the building of new homes is up to about 30%. So you are forcing first-time buyers to use new construction built homes to take on that 30-year amortization and just extract more taxes out of them, because that first-time buyer of that new home is going to pay all those input taxes of about 30%, folks. So if you're buying a $750,000 new home, close to $225,000 is input taxes, development charges, parkland dedication fees, school levies, HST, input taxes, on and on and on, okay? So is this really a good thing? Is it really all about extracting as much out of a first-time buyer that is imaginably possible? I think it's a fucking scam, okay? Just beware, be wary and beware. Like, this is only going to create more demand and cause a further problem when it comes to the fact that we don't have enough properties to sell. Now, on another point, the Office of the Parliamentary Budget Officer came out with a report indicating that there is going to be a considerable housing gap relative to household formation, okay? And it's going to cause the vacancy rate for rentals to further drop, which is going to make it tighter. It's going to drive rents up. And I want to point out something that the report indicated. Okay, from 2000 to 2023, there were 4.5 million units built, okay? 4.5 million in a 24-year period. That's about 195,000 units a year. So that's your baseline. The Parliamentary Budget Officer indicated that there is a shortfall of 181,000 units per year that are not being built, okay? So in the next 7 years, they have to build 3.1 million homes. 3.1 million homes in the next 7 years. In the previous 24 years, they built 4.5 million homes in Canada. How are they going to do it? This is absolutely impossible. And this government is introducing tools to drive more demand. Folks, this is starting to get absolutely ridiculous. It makes no sense. And if anybody thinks that rates are going to be coming down anytime soon, you better give your head a shake, because it's not going to happen. The inflationary spending is going to drive rates further up. We're already seeing the bond market move upwards, not down, and we can anticipate some of the lenders start increasing some of their 5-year fixed rates again. So It's really concerning that this government is not understanding that they got to tighten their belts and stop spending. There's too much excess spending in the system to allow inflation to drop, and it's going to give the Bank of Canada fits about it, and it's not going to play out very well. You know, on that front, the real estate market in GTA has been grinding sideways. March's results were absolutely blah. You know, it was the lowest in a couple decades. You know, this is supposed to be a spring market. We had great weather. You know, where's everybody, you know, lining up at the open houses? Where are all the multiple offers? It does happen in certain pockets and certain areas that are highly desirable, but across the board, we're not seeing the activity everybody thinks is supposed to happen. And that's because people can't afford to pay the mortgages and qualify for mortgages at a reasonable rate. It's just not happening. And when we're seeing more and more layoffs come down the pipe, people are just not very secure about their jobs. And when people don't have job security, they're not buying big ticket items. So it's very important that we understand that just because the Bank of Canada is going to drop rates at some point in time, okay, and I don't know when it's going to happen. Everybody thinks it's now going to be June, maybe July, but the reality is it's not happening if government continues to spend, and that budget mid-month is going to be really interesting to see how it's going to be received by the Bank of Canada. Sorry to sound the alarm, but this is not looking good. It's getting worse. And you know, I do get a lot of DMs from people saying, oh, everything's great, Vince. It's not that bad. I see restaurants still full and stuff. Well, people still have credit cards. People still have limits available for them to spend. But the reality is the average person is struggling. We have 2.2 million folks that are renewing their mortgage in 2024 and 2025. 2.2 million, okay? And we've just gotten through one of the 8 quarters of that time period. So we still got 7 quarters over the next 2 years through to end of 2025 to see more and more folks getting choked up about how much disposable income is going towards their housing costs. And I should point out, RBC came out with that affordability index, and using Canada's median income, about 63.5% of median household income is going towards housing costs. Carbon tax went up on April 1st, which means housing costs are going up to heat your home, whether it's gas, electric, or whatever, okay? So costs are going up, interest rates are going up. And in Toronto, that number is over 80%. In Vancouver, it's over 106%, which is absolutely mind-blowing. And there's a major crisis going out there. So it's going to be really, really interesting to see how all this plays out. And folks, do your budgeting. Focus in on your household budget. Understand what's coming in as far as income, and try to tighten up on your expenses. Focus on the needs, not the wants. Print out your bank statements, print out your credit card statements. It's so critical to print them out and see a full month. One of the biggest problems I find is that this online banking bullshit has only limited people to see 4 or 5 transactions at a time, and they're not keeping track of everything that goes through their bank account. So do yourselves a favor and print out your statements. I know you could save $2 by going online and digital, but not many people do it. Not everybody looks at their documentation of their statements to really drill down on what they're spending. And I'm telling you, you'll find savings just going through subscriptions, you know, quick little $4 or $5 transactions here and there because of the ease of tap payments. So I encourage people to just do some due diligence on their budgeting and try to get a grip and get ahead of this, because it is going to get bumpy, and we are going to start seeing the impact of the carbon tax on food and everything as the system filters through in time. We're going to go into the Q&A, so tighten up the chin straps on the helmets, and we're going to go into some Q&A. Get ready, folks. So let's start off with the first one. If your private mortgage is in good standing, shouldn't a renewal be offered? I have been advised that the lender needs their funds paid back, putting me in a tough position. What can I do? Okay, well, that's not good. So here's a situation where somebody has a private mortgage, they've probably made their payments on time, and at the end of the term, and usually privates are 1 year or so, they're not getting a renewal. The private lender, whoever it may be, a person, entity, or whatever, they want their money back. They're not offering a renewal. And this is coming up quite a bit, and it's concerning because if values have come down, it's making it very difficult for people to find additional resources to lend them money in the private sector when the property values come down, increasing the risk of the loan to value going higher. Okay, I'm trying to break this down as simple as possible. So it's putting people in a tough spot, and then you have all the additional set of fees again, right? You got a new appraisal, you got more legal fees, you're paying your legal fees, you're paying the lender's legal fees, there's lender fees, broker fees, and rates. And if the risk is higher, you're probably going to be paying a higher rate. So this is where I think people need to be very careful who they deal with. Deal with a mortgage broker that has experience and has a wide vast of options in the private space, especially mix and alternative lenders. Because if you're dealing with a MIC that's a large MIC, they do have the resources to offer you renewals. Whereas if you're dealing with mom and pop and they put money on their line of credit to invest in private mortgages, which a lot of people did, thinking that, well, I can make some money. I only pay 2.5%. I could earn 10, 12. I'm making money. But now as prime has gone up, risk has increased, values have come down, everybody's kind of closing up shop saying, I want my money. I don't want to be part of this anymore. And maybe they experience some challenges. So it's very, very important you deal with a professional that gives you a reputable private lending institution that will have the opportunity for you to get a renewal, and maybe even put in the renewal that if you do make all your payments on time, a renewal will be offered at such and such fee and rate. So you want that assurance that you're not going to be left out in the cold, because this situation is not good. Okay, this is just a terrible and fucked up bear trap that's going to gnaw at you, get you right to your bone, gnaw at your foot, and you're not going to be able to get out. You might have to sell if you're stuck. It's just not a good situation. And I caution people, be very careful. Hey Vince, did you get any interesting insight to the real estate market in Vancouver? That's funny. For those that don't know, I was out in Vancouver last week. I did my show, episode 176, from Vancouver, the Centum head office. I spent a few days out there, and I got to tell you, for those of you that have been watching regularly, I had that used Porsche counter, and we tracked how many used Porsches are for sale. Out in the marinas in Vancouver, there's a lot of for sale boats. Like there's a lot of boats and yachts for sale. So they're feeling it. It's not Porsches, it's yachts and boats that are for sale in numbers. They have hit crisis mode in the real estate market there. It is getting ridiculous, as I pointed out earlier. We are seeing the Housing Affordability Index that was put out by RBC indicate that Vancouver needed over 106% of medium household income to afford a property or a home in the Vancouver market, which is absolutely crazy. Ontario's sitting at just over 80%. I think it was 82 or 83. I can't remember what number the exact number was, but it was over 80. And it's really ugly out there. Very tough to qualify for mortgages. First-time buyers are pretty much shut out of the market there, and you have to go out into the interior and hours away in some cases to afford anything. So a very tough market. One thing that I did pick up there in the paper was that BC had a negative net migration out of the province. They lost 68,000 folks that moved out of province, and over 50% of them went to Alberta, and the rest scattered the rest of the province. So people are getting out of there, and they're basically, their two top reasons why they're leaving is affordability and economic opportunity. They're just not seeing the opportunity there that is elsewhere. So, interesting. We'll take one more. How is it possible for realtors and the purchasers of a property ask for an abatement a day before or the day of closing? Okay, you know, this is an interesting question, and I think this was probably brought on by somebody that we just went through a scenario with. We had a case recently, this past Monday, where a client was closing their home, and elderly couple, and on the day before the closing, the real estate agent for the purchasers said that there was a potential problem with some cracks in a wall in the basement when they did their last house visit. You know, usually people get 2 visits to the home, and they wanted an abatement of $20,000 or $25,000. Can't remember what it was, and it put everybody on notice, and it really created a bit of a kerfuffle. And what was interesting about it is this purchaser did do a house inspection and did waive the inspection clause that was in the original purchase offer. So the vendors basically said, go pound salt, okay? You did your house inspection, go to your inspector who didn't identify this, and close, because if you don't, you will be in breach of your contract. We will keep your deposit, list it and sell it to somebody else, and sue for damages. And you know, they went a lot of back and forth, a lot of anxiety, a lot of stress, older folks, you know, not really liking the situation they're in. But you know, in speaking to the lawyer, this is a common tactic. This is a common tactic, and sometimes abatements are needed. Okay, like sometimes you go in and people don't clean things up, people don't leave it in a broom swept state, and there might be a request to hold back some fees to pay for some cleaning, disposal, whatever. Or you know, there's a window broken, or the air conditioning doesn't work, or something is odd where it wasn't the case when they first saw the property. So in some cases, abatements are necessary for whatever reason, but in this particular case, it was truly a tactic to try to get a discount off the purchase price, and the sellers didn't balk at all. They basically said, go pound salt, you close it, and otherwise you face the ability of a lawsuit. And in this particular case, the purchasers did close. They did file a protest, whatever that means, and it went on. But you know, this is silly. You know, if you have an inspection clause and you've waived it, you pretty much should be going after your realtor who advised you to waive something that you shouldn't, or you go after the home inspector who gave you a shitty report. So a little bit interesting situation. Great question. Never got that one before, but hopefully that's added a bit of insight into the world of real estate as we know it.